You generally picture humans at the center of the global economy, right? I mean, you get a paycheck, you buy a coffee, you invest in a stock, launch a company. It's this closed loop of human intention and human capital.
Right, that's how it's always worked.
Yeah, exactly. But jump with me into the digital landscape of 2026, and that human fingerprint is it's suddenly gone. We are looking at a reality where the biggest market movers out there don't sleep, they don't drink coffee, and they certainly are not human.
No, they're not. It's wild.
It is. So today, we are tearing into a massive, diverse stack of sources for you. We've got cutting-edge blockchain research, venture capital reports, AI tokenomics data. Our mission today is to really map these massive shifts in how capital and intelligence are moving in 2026.
And we're seeing shifts that we, frankly, couldn't have fully predicted even 2 years ago.
Totally. We're going to explore how AI agents are generating their own autonomous GDP, how developers are desperately trying to cryptographically chain these bots to, actual human accountability.
Which is a huge challenge right now.
Oh, absolutely. Plus, we'll get into the shifting power dynamics between mega blockchains like Ethereum and Solana and a very surprising plot twist in the flow of global venture capital into Africa.
It's a complete paradigm shift.
Yep.
Because we've spent the last few years basically treating AI as a really smart assistant.
Right.
You ask it to write an email, it writes the email. But what the data for 2026 shows is this massive leap from tools that assist us to autonomous actors that literally replace us in the transactional flow.
They're actually opening wallets.
Exactly. They hold their own funds, they make decisions based on live market data, and they execute trades without ever asking you for permission.
Okay, let's unpack this, because the term being thrown around in these latest Missouri reports is agentic GDP.
Yes, agentic GDP.
Which, this isn't theoretical anymore. In the first quarter of 2026, the AI agent economy on the Solana blockchain officially transitioned from, a fun sandbox experiment to real measurable production. We're talking about measurable economic value generated autonomously by non-human actors.
And, if you are listening to this and wondering what that actually looks like in practice, consider the gaming sector.
Oh, the Play Babylon example.
Yeah, Play Babylon. So shortly after it launched, researchers tracked 11,171 autonomous AI agents playing this multiplayer game. And those agents executed 490,000 financial transactions in just 5 days.
Wow. Over 1,000 bots just doing business?
Yep. They are paying for in-game items, trading with each other, moving real capital around, and not just one single game.
Right. And the research also highlights the Virtuals protocol, which operates sort of like a monetization layer for these bots.
A really massive one at that.
Yeah, their dashboard is currently showing 479.1 million USDC in total agentic GDP and over 1.7 million completed jobs. So an AI gets a task, hires another AI to help it, pays that second AI in crypto, and then delivers the result.
What's fascinating here is the physical infrastructure required to make this machine-to-machine economy actually function.
Right, because it can't just run on anything.
No, exactly. If you think about an AI agent scraping data, running complex inferences, reacting to market conditions, it is doing this thousands of times a minute. It operates at pure machine speed.
So it needs instant feedback loops.
Absolutely. If an agent has to, say, pay a $5 network fee, or wait 12 seconds for a block to finalize on a legacy blockchain just to execute a single API call, its unit economics instantly collapse.
It just goes bankrupt trying to operate.
It does, which perfectly explains why they are all migrating to Solana as this de facto lab.
Right, because if your bot needs to make 1,000 microtransactions a day, it needs Solana's sub-second settlement. They are clocking transaction times under 400 milliseconds.
And the fees are a fraction of a cent. That speed and frictionless cost structure is basically non-negotiable for AI.
And the entire Solana ecosystem is aggressively optimizing for this, right? Industry leaders are calling it the billion TPS North Star.
Yes, billions of transactions per second. They are positioning the network to be the central nervous system for a true machine economy.
And they're building the actual plumbing to support it, not just the raw speed. I saw in the reports that Solana recently added support for Stripe's machine payments protocol, the MPP.
Right, MPP is huge for this.
And they also integrated the Open by 402 standard, which is that standard Coinbase designed specifically to let AI agents automate payments securely.
Exactly. But looking at all this autonomous wealth creation, there's an obvious dark side here.
Yeah, I have to assume this is an absolute minefield of
Oh,
risks.
it really is.
Yeah.
The sources outline three massive vulnerabilities that come with giving software its own wallet. First is centralization risk.
Because of the off-chain dependency.
Exactly. These agents operate on-chain, but their brains, the large language models determining their logic, are hosted off-chain by centralized tech giants.
Right.
So if a provider changes an API rule or updates a safety filter or just suffers a server outage, your autonomous trader is instantly brain dead. Its funds are locked on the blockchain, but it has no capacity to act.
Man, it's like a stockbroker suddenly forgetting how to speak right in the middle of the trading floor.
That's exactly what it's like. Then you have execution risk. You see, humans have a built-in latency. We panic, we pause, we think about things. Agents don't.
They just react.
Right. So we can easily see these algorithmic flash crashes where tens of thousands of agents simultaneously read the exact same market signal, and they trigger stop losses at sub-second speeds. The market could cascade before a human even refreshes their screen.
That's terrifying. What's the third risk?
Shadow regulation. When autonomous programs start managing hundreds of millions in total value locked, regulators are going to notice. At what point do they demand that a bot register as an unlicensed financial advisor?
Okay, that actually brings up a critical question, and it's something I think anyone listening would be wondering right now. If these agents are moving hundreds of millions of dollars at machine speed, how do we actually stop a rogue bot? I mean, if an agent is fundamentally just a piece of code holding a private key, isn't that like handing a toddler a loaded credit card and hoping for the best?
It is exactly like that.
Yeah.
And that highlights a vulnerability that researchers call the semantic gap.
The semantic gap. What does that mean in this context?
Well, in the traditional crypto world, if a transaction is signed with a private key, the network just assumes it's valid. It only proves possession of the key.
Right. It doesn't care who is actually typing on the keyboard.
Exactly. It does not authenticate the physical identity of the human operator who deployed the bot, and it certainly doesn't guarantee that the bot's code hasn't been secretly altered.
Got it. So if a hacker steals the private key of my AI agent and they rewrite the code to drain the wallet into their own account, the blockchain just sees a valid signature and processes the theft.
Yes, that is the semantic gap. The network doesn't know the difference between the toddler and the parent, to use your analogy.
So how do we fix that?
Well, the solution detailed in the latest computer science research is a framework called BAID, B-A-I-D, which stands for Binding Agent ID.
Binding Agent ID.
Right. It implements this binding agent model with a very specific goal: to cryptographically leash every single autonomous agent back to an accountable human or organizational principle.
That makes sense, because if an AI commits fraud, you can't put a line of code in prison. You have to find the human.
Exactly. You need human-to-agent liability.
But how does this BAID framework actually link a digital bot to a physical human without broadcasting everyone's, private passport data or biometric data onto a public blockchain?
It's clever. It layers three different mechanisms. First, it uses local biometric authentication. So your fingerprint or Face ID on your local device is cryptographically embedded into the initial configuration of the agent.
Okay, so it starts on my phone or laptop.
Right. Second, it uses decentralized on-chain identity. The framework leverages a standard called ERC 4337, which allows for account abstraction.
Ah, so gas sponsorship.
Exactly. This lets the verified human sponsor the network gas fees for their agent, which establishes a really clear on-chain trail of financial responsibility.
Okay, let me push back on that for a second, though. Even if you link my biometrics and my wallet to the bot, that still doesn't solve the tampering issue, right?
How do you mean?
Well, if the code is open source, what stops a malicious actor from cloning my bot, swapping in their own receiving address, and just using it?
That is where the third mechanism comes in, and this is a massive breakthrough. It's a novel ZKVM-based code-level authentication protocol.
Okay, ZKVM, that stands for Zero Knowledge Virtual Machine.
Yes, exactly.
So for you listening, zero knowledge proofs are basically the cryptography that lets you prove, a secret like a password without ever actually revealing the password itself. We usually see this used for privacy.
It is mostly used for privacy, yeah. But in this framework, it's used to guarantee execution integrity. The ZKVM treats the actual program binary, the raw compiled code of the agent, as its unique identity.
Oh, wow. So the code is the identity.
Yes. When the agent wants to execute a trade, the ZKVM generates a cryptographic proof of its entire execution trace.
Meaning it proves the exact sequence of logic the bot just followed?
Precisely. It mathematically proves to the network that this specific agent, authorized by this specific binding user, used the exact unaltered committed code to arrive at this specific transaction.
And it does all of this without revealing the sensitive operational details, right? Or the proprietary logic or prompts.
Correct. None of that goes public.
So if a hacker changes even one line of code to redirect the funds, the execution trace changes, the zero-knowledge proof fails, and the transaction is just blocked.
Exactly. It proves what code is running, not just who holds the key.
That's incredible.
It entirely bridges the liability gap. When that agent interacts with a decentralized exchange or even a real-world merchant, that third party receives ironclad cryptographic proof that they are dealing with the correct, unaltered agent.
So what does this all mean? We have this massive agentic GDP exploding on high-speed chains like Solana, and we have developers building wildly complex zero-knowledge biometric frameworks to keep them accountable.
It's a lot of infrastructure.
Yeah. All of this intense machine-to-machine activity requires a very specific kind of underlying architecture. And according to the ecosystem reports we're looking at, this demand for scale is driving an absolute wedge between the major blockchain ecosystems.
It really is a structural turf war right now. And Ethereum, the network that literally invented smart contracts, is, it's going through a very severe identity crisis in 2026.
Yeah, reading these reports, the first half of 2026 has been incredibly turbulent for the Ethereum Foundation. At least 9 senior contributors left. I mean, veteran researchers and protocol leads.
And 5 of them departed in May alone.
Right. And the market is reacting to that internal friction. Ethereum's price is down roughly 26% year to date, but more importantly, network revenue is losing ground to these nimble upstarts.
Right. Users and bots are migrating.
Exactly. But Ethereum's co-founder, Vitalik Buterin, he recently published a vision that completely pivots the foundation's strategy.
Yes, he's pushing a philosophy called CRAPS.
CRAPS, which stands for Censorship Resistance, Open Source, Privacy, and Security.
Right. He is essentially arguing that Ethereum should stop trying to compete on pure speed and cheap fees.
So while Solana is trying to build this massive, hyper-fast, 6-lane superhighway where AI bots can trade millions of times a second for fractions of a penny, Ethereum is basically trying to become Fort Knox.
Fort Knox. That is an excellent way to frame it.
They don't care if the line to get inside is slower or more expensive. They just want to build a credible neutrality moat, right? The single most impenetrable, decentralized vault on the planet.
Exactly. Vitalik is pushing for provably bug-free software through AI-assisted formal verification, unparalleled safety standards. He firmly believes that black space isn't just a cheap commodity. It's differentiated by the security backing it.
And there are metrics in these reports showing that this Fort Knox strategy is actually resonating with long-term believers.
It is.
Because despite that 26% price drop we mentioned, the amount of Ethereum being staked, meaning it's locked up to secure the network, that actually rose from 29% to 31%.
People are willing to lock away their assets because they trust the security model.
Right.
Furthermore, Ethereum isn't completely ignoring the user experience. Vitalik confirmed that native account abstraction is finally coming in the upcoming 2026 Hegota Fork.
Okay, via EIP 8141, right? Let's clarify what that actually does for the listener.
Sure.
For years, if you wanted to do anything on Ethereum, you had to hold Ethereum tokens just to pay the transaction fee. It's like going to a currency exchange that only accepts its own currency as a processing fee.
It's always been a huge pain point.
Yeah, but EIP 8141 introduces smart accounts. It basically upgrades your wallet into a programmable bank account. You will finally be able to pay network gas fees using non-ETH tokens, like stablecoins. Plus, it enables quantum-resistant wallets.
It removes massive friction points. But the question everyone is asking is whether it's too little too late.
Because the competitors are booming.
Exactly. While Ethereum plays the long game, building out this pristine, credible neutrality, the competitors are capturing the momentum of today. They are optimizing for fees, throughput, and user experience.
Let's look at that momentum, because the numbers in this Messari report are just wild. We already mentioned Solana, which, by the way, achieved 100% network uptime in 2025.
Finally shaking off its old reputation for crashing. Yeah.
Right. And they launched FireDancer. In early 2026, Solana hit $110 billion in decentralized exchange volume. That single chain beat all of Ethereum's Layer 2 networks combined.
And speaking of those Layer 2 networks, look at Base. This is the network built by Coinbase, and it has absolutely exploded to $10.7 billion in total value locked.
$10.7 billion.
Yeah. And the mechanism driving this isn't necessarily superior technology, it is pure distribution. Coinbase has funneled its registered users directly onto this chain. They are processing nearly 13 million daily transactions because the onboarding friction is virtually zero.
Then you have networks taking a completely different architectural approach, like Hyperliquid.
Oh, Hyperliquid is fascinating.
They hit $179 billion in monthly perpetual futures volume.
With a comparatively small number of users, that user-to-volume ratio is incredibly telling. If you look at how Hyperliquid works, they didn't build a general-purpose blockchain where people can launch meme coins or play games.
No, they built a custom Layer 1 network from scratch, optimized solely for a decentralized order book.
Exactly. It stripped away all the bloat. So it attracts professional, institutional traders who demand deep liquidity and sub-millisecond execution.
Even Bitcoin is getting dragged into this turf war. Thanks to new protocols allowing native staking and smart contracts, Bitcoin DeFi has skyrocketed from basically near zero to $6.3 billion in TVL.
If we connect this to the bigger picture, you can really see two very different philosophies colliding here.
Yeah.
Ethereum is betting that credible neutrality and absolute security will ultimately attract the world's largest institutional assets. But the newer chains, Solana, Base, Hyperliquid, they're winning today by betting that users, developers, and AI agents care more about throughput.
They are establishing massive network effects right now. It's really a race to see if Ethereum can execute its vision and finish building Fort Knox before the window of network effects closes.
Exactly. Before the entire global economy is permanently relocated to the superhighway.
Here's where it gets really interesting. We have just spent, the last 10 minutes talking about how digital capital and builders are shifting dramatically between these blockchain ecosystems.
Right.
But if we look at our final set of sources, real-world venture capital is undergoing a massive geographic realignment of its own.
The venture capital data for emerging markets is incredibly striking this quarter.
Yeah, African startup funding hit $705 million in Q1 of 2026. That is a massive 26.5% jump year over year, spread across 59 major deals.
And the usual heavyweights are pulling in the capital. Egypt secured $190 million, South Africa brought in $157 million, and Kenya hit $94 million.
But the surprising twist here isn't the volume of the capital, it's the origin.
Right. Historically, if an African startup was raising a massive round, that term sheet was coming from the US or European sources.
Silicon Valley, London, Paris.
Exactly. But the data shows Japanese investors are now aggressively entering the space.
And we should explore why. This isn't just passive financial investment, is it?
No, it's highly strategic. Japanese conglomerates and VC firms are scouting for expansion and acquisitions. They have an aging population at home and very mature markets, so they are looking at Africa's massive, young, mobile-first population as their ultimate growth engine.
Which completely changes the competitive calculus for foreign brands. I mean, if you are a Western brand or a European VC trying to dominate the African market, you are no longer the only major player with deep pockets.
No, you're competing against highly strategic, long-term Asian capital.
However, the reports also highlight a pretty brutal reality for these African founders. Despite the $700 million boom, the ecosystem still struggles with a structural bottleneck known as the missing middle.
Ah, the missing middle. It's a notorious funding gap. In many emerging markets, a founder can usually scrape together a pre-seed round from local angels to build a prototype. Right. And on the other end, if a company has a proven model generating millions, massive global funds are happy to write a Series B check. But the journey between those 2 points, moving from prototype to Series A, is where most startups run out of cash.
It is the valley of death.
Yes. To combat this, an organization called Digital Africa has launched a new vehicle called the Digital Africa Seed Fund, or DAF.
The DS.
It's a 30 million euro fund, building on their earlier Fusée initiative, which previously deployed 10 million euros.
And looking at the mechanics of the DAS, they are highly targeted. They are selecting just 30 companies across 20 African markets.
With average investments around 300,000 euros.
Yeah.
And more importantly, they are providing both capital and operational support.
Right, because 300K doesn't fix poor internal governance.
Exactly. They are embedding advisors to help founders recruit talent, secure regional licenses, and build out execution frameworks.
So if you step back, the thematic parallel to our earlier discussion is actually profound.
It really is.
Just as the builders on blockchain are fiercely searching for the right infrastructure like Base or Solana to grow their agentic GDP,
African founders are finally getting the financial infrastructure, like the DASF, to cross their own valley of death between prototype and Series A.
In both realms, we are moving past the experimental phase and demanding execution. We've covered incredible ground today. From autonomous AI agents generating real-world GDP on high-speed blockchains to the cryptographic biometric BAID frameworks keeping them in check.
We navigated Ethereum's structural growing pains.
Yep, and finally tracked the Japanese-backed surge in African venture capital.
It all points toward an impossibly fast, highly autonomous global economy, which leaves us with a final thought to ponder.
Let's hear it.
As African startups rapidly scale with this new global capital, and as AI agents become capable of autonomous corporate coordination, how long until we see an emerging market tech giant entirely managed, scaled, and operated by a verifiable AI agent swarm?
A massive platform crossing the valley of death with no human fingerprints on the steering wheel. That is something to think about. Thank you for joining us on this deep dive. Until next time, keep questioning the world around you.